Good evening, everyone. My name is Friday. I also have my colleague Riley on the call.
Hi, I'm Celine, and what my call is.
Hi, my name is Darren.
All right. So for us, we'll be looking at a case study for a couple, and we'll be making dissection as well as evaluating the couple's family composition, their network statement, and making recommendations for the couple. So that takes us to an introductory slide where we have this outlined as our agenda, which is displayed right here. The next slide we'll be looking at shows us the composition of the client's family setting. The client happens to be Mr. Anthony, aged 55, married to Claire, aged 51. This couple have twin called Charlie and Karen, both aged 10. However, Anthony was previously married to Sophie, and they had two children from that union, Frank and Zoe, aged 20 and 14 respectively. Claire, on the other end, was previously married to Grant, and they had three children from this marriage. Roy, aged 25, who happens to be disabled, Hannah, aged 23, and Joseph, aged 20. Looking at this couple family composition, the next slide we'll be looking at shows us the financial standing of the client. And from here, we are evaluating the net worth statement for the client. And from this end, we're looking at the asset of the client alongside their liabilities. The total summation of the client assets is valued at 3,594,020 Canadian dollars. And the total liability for the client is valued at 650,000 Canadian dollars. The net worth statement from this end displays the summation, the evaluation of subtraction of the asset from the couple's liabilities. And that is valued at 2,944,020 Canadian dollars. This shows us the couple have a good financial standing. And the next to what we're reviewing is our estate planning recommendation for the client, Mr. Tony and Miss Claire. And first on the list for us is a business succession and transition plan. Given the case study presented to us, Mr. Anthony basically owns a fabrication plant known as Movie Land. However, he doesn't own the full-fledged ownership to this firm. He has a 45% equity stake in the firm, alongside Bill and Jane, who has 20% equity, as well as Jane, who has 30% equity share. The corporate structure of the firm, Movieland, does not visibly attenuate the organization succession plan, shareholders' interest, ownership structures and rights, as well as any prospective partnership agreement. Therefore, with these lapses identified, it implies that this firm cannot be transitioned into Anthony's estate planning scheme. However, looking at what we have on our end, we recommend that Movieland be incorporated. This will ensure shared transferability to the couple's estate planning need. Besides just the estate planning need for the couple, for Anthony, there are some other benefits they would enjoy incorporating Movieland. One is Movieland becomes a limited liability company. This implies that Movieland becomes a separate legal entity with limited liability protection. For this, the couples of the shareholders' assets will be protected from any business-related liability or debt. On the other end of it, it also presents them a tax planning opportunity. Basically, Movieland can take advantage of certain tax deduction and incentives available to business. This would imply potential staff savings for the owners, as corporate tax are quite lower than personal tax. On the other end of it, incorporating Movieland would also allow them factor in that firm into their succession planning, making it part of their estate planning scheme. What this can do in the other end is it outlines the ownership structure of the firm, transferability of shares, also making it easier for each of the shareholders to bring any partners or transfer their own portion of the shares to a family member in the future. However, would like to get clarity from Mr. Anthony as the majority shareholder of the firm, if he can convince other shareholders, which is Bill and Shane, on complying to the corporate governance demand of incorporating their company, Moviland, as it demands that they document their audit reports, file annual returns, as well as hold an annual AGM or shareholders meeting. Second to it would be the insurance need analysis for the couples, which is our second composition of the couple's estate planning scheme or recommendation. Mr. Anthony has a term life insurance policy valued at 250,000 Canadian dollars. However, this insurance policy has Sophie as the beneficiary and has a 3-year renewal plan. The couple Anthony intends to know if the 7,000 Canadian dollars policy scheme would be sufficient for his estate planning need. We also have Claire, who has a permanent policy with a term rider valued at 100,000 and the term rider valued at 500,000. The renewal is actually targeted at 2026. For Claire, she'd want to know if the combined sum of 600,000 Canadian dollars on her policy would be adequate to meet her financial security goal. Now, given the client's relatively high net worth and the complexity of the family composition, the couple would need to also provide for their disabled son, which is Roy, throughout his lifetime. Our recommendation would be that they increase their current insurance coverage. Nonetheless, would need to get clarity from the client. What is their intended estate distribution plan for Roy? And also, how does it accommodate Roy, knowing the fact that they will need to make provision for him for his whole lifetime? This will enable us to evaluate the sufficiency of the current insurance scheme. Also, this would need to get clarity from the client as to their financial obligation. For Anthony, the child support he has with Sophie, which is contained in the divorce agreement, as well as Claire's potential income replacement, knowing that she'll be resigning or retiring from her work in 4-year time. The client response to these valid questions would help us know the next best insurance policy option for them, judging from the policy terms or insurance plan, as well as the potential premium payment. So I'll be handing over to my next colleague on the call, Zelang, to help with further recommendations. Over to you, Zelang.
Yeah, thank you, Friday. I can start with estate planning strategy, and I divide it into 2 parts. Firstly, assess the assets of Anthony and Claire, as well as potential estate tax and tax liabilities. Given the scale of their assets, this step is crucial as it will impact their estate planning decisions. Consider giving assets during their lifetime, which can reduce the burden of estate taxes and allow them to see how their wealth is utilized while they are still alive. Portions of their wealth can be transferred to their children while Anthony and Claire's still alive. Utilize tax-efficient investment. These accounts can defer taxes to some extent, thereby reducing their tax burden. Establish testamentary trust, which can help minimize estate taxes while ensuring assets are distributed according to their wishes after their passing. This is especially important for a disabled child like Roy. A trust fund can ensure Roy receives proper care and support after Anthony and Claire's passing. Second, choosing the optimal ownership transfer method. Consider transferring ownership of a real estate assets to their children or establishing trusts. This may involve re-registering property ownership to minimize the burden of estate taxes, and seek professional legal advice. Address outstanding mortgage obligations. That is important too. Anthony and Claire should assess their mortgage liabilities on each property and determine the best course for action. Explore leveraging real estate assets to maximize their value, and which may include releasing capital through refinancing or other means. Thank you. And we can also start from considering child support considerations. Firstly, carefully review the child support agreements between Anthony and Sophie, as well as Claire and Grant. They need to understand every provisions in the agreements, including payments, amounts, frequency, and duration. Based on the children ages, educational status, and the specific termination dates in the agreements, determine the remaining obligations for each child's support, considering that Frank is attending college while Zoe is still in high school. Their support need may differ. Second, plan for Frank and Zoe's education expenses. Considering Frank's college attendance, he may require funds for tuition, accommodation, books, and living expenses. Meanwhile, Zoe is still in high school and may have more other expenses. They can discuss with the children and their respective parents to decide how to share these costs and ensure the children receive the necessary support. One more, consider utilizing registered education saving plans to fund the children's higher education, which can attract government matching funds. Additionally, they can assist the children in applying the scholarship, grants, and student loans as another sources of funding. And now I pass into
Update wills and estate documents. So both Claire and Anthony need to update their wills immediately to reflect their current new marriage status, children, and assets accurately. Anthony should remove his ex-wife as the executor and beneficiary, naming Claire as the appropriate, ensuring her estate plan aligns her current family tree is essential. They should both reconsider power of attorney to ensure they are realistic and think back about their current wishes about her brother who lives in Edmonton as power of attorney since he lives too far. On to the next slide, we have special needs trust for Roy. The couple must open up a hens trust fund for Roy to ensure his inheritance doesn't affect his eligibility for government disability benefits. This will allow for trustees to have a full control over disbursement, making sure Roy needs are met without directly providing assets, which could potentially destroy his benefits. In conclusion, by following these recommendations, Anthony and Claire can create an estate plan that secures their family's future, addressing the complexity of the blended family, and fulfill their wishes to leave a lasting legacy. Engaging with professionals like us in estate planning, tax, and financial advisory will be vital in implementing these strategies efficiently, ensuring a peace of mind for Anthony, Claire, and their loved ones.
I want to say thank you once again for the time, for allowing us to review this case study. Thank you.
Thank you. So how was that conclusion? Oh, he left. I think we should leave the call so he can save it.